Good morning, students. We will start chapter 9, Fundamentals of Capital Budgeting. The outline will be the first section will talk about the budgeting process, and second section talks about forecasting incremental earnings. We will calculate how when we are in the process of capital budgeting, how we calculate the incremental earning. We will see there. We will determine the incremental free cash flow next. After that, we'll see the other effects on incremental free cash flow, and we'll analyze the project. What are the real options available in capital budgeting? We'll see in this chapter. So, capital budget is the process of deciding the long-term investment plans. Budgeting is the way, the modus operandi, the plans, the techniques, applying the techniques, and deciding whether to go for the investment or not. Incremental earnings are being used for uh, deciding the capital budgeting decision. Let us see how. When we are talking about a long term investment plan or a long term investment project, these are the way of making the investment plans, or these are the three different kind of stages. What are they? In the first stage is initial investment or initial outlay of cash. What is that? That is, you purchase an equipment, you spend some money for the development of that equipment, installing the equipment, and you uh, you introduce some working capital for running the project. That is the initial requirement for starting a new project. You spend for the project. If it is buying an equipment, you purchase the equipment. You spend some money for initial developments. You introduce some networking capital, that is, you introduce inventory and other working capitals like receivables and net with payables. Then you will get the networking capital. So you introduce some networking capital for running that project, the initial stage. Once it is ready, then it will have ongoing cash flows. Cash flow year 1, cash flow year 2, year 3. Throughout the life of the project, you will have ongoing cash flows. What will happen there? The incremental revenue, because you have uh, introduced a new project, the new project will give some additional revenue, which is incremental revenue. For getting that additional revenue, you have to spend some cost. So for incremental revenue, you will have incremental cost. Then once you are getting incremental revenue minus cost will be the earning before tax, earning before interest and tax. So taxes will be deducted. After you deduct the tax, it will be and there will be change in net working capital. You introduced the net working capital in the beginning. Maybe during the life of the equipment, you need some more working capital than or less working capital, either of the two. So change in net working capital throughout the life of the project. Then what will come? First we have seen initial, then throughout the life. Now this is the terminal. When the project comes to an end, the life of the project finishes. What will happen? Terminal cash flows. What are the terminal cash flows? The equipment which you purchased, it will be sold because it is no more useful for the company. It completed its life. So whatever remains, that will be sold. Sale of equipment. Net of tax. We will see how. Sometime you have to spend some money for shutting down the project, for closing the project. For example, your project is using some harmful chemicals, then it should be properly shut down. You have to take care of certain precautionary measures. All these things involve cost, which will be known as shutdown cost. And the working capital which you have introduced in the beginning and throughout the life some changes occurred, at the end the working capital will be released, because to start the new project you introduce a new working capital. When the project closes, that working capital is released. These are the three different processes in a capital budgeting. We have to take care what the initial things we have to do if we want to go for this project. What are the initial outlay the company has to incur? After initial investments, what are the ongoing things will happen from this project? And end of the project, what will be the terminal cash flows involved? Once you have a proper idea of all these things, the prediction becomes easier. Let us go one by one, let us see. So, forecasting the incremental earnings, as we have seen from the previous slide, that two things are coming here: operational expenses and capital expenditure. So, how it happens? The operational revenue and the capital expenditure, how we go for? Number one, the new product typically has a lower sales initially. That you have to keep in your mind. When you, the three factors always you have to keep in mind when you are thinking for incremental revenue and cost. Why? Because the incremental revenue in the initial stage might be lower than the normal revenue, because the equipment is not properly geared, the equipment is not properly ready for work, so initially the revenue might be lower than the normal revenue the equipment will generate. The average selling price of a product and its cost of production will generally change over time. Don't make a kind of prediction blanket straightforward. The cost of production will be this much, or the revenue will be this much per unit. It might change over its life. Most industries, competition tends to reduce profit margins over time. So once the competition increases in the market, the profit margin goes down, and it happens gradually once time passes. So certain things we have to use in the equation. Equation 9.1 talks about the earning before interest and tax. You all know how we calculate EBIT. EBIT is equal to incremental revenue minus incremental cost minus depreciation. You understand where it is? You see the incremental revenue ongoing phase. What is incremental revenue? And the incremental revenue is equal to incremental sales minus incremental cost minus depreciation. Will give you the incremental revenue minus incremental cost minus depreciation will give the kind of uh, uh, the incremental earning before interest and tax.
Doctor, the screen isn't visible to us.
Not visible?
No, you're not sharing it.
Just give me a minute.
Okay.
All right now?
Yeah, all clear.
So the EBIT is clear now. Revenue, additional revenue or incremental revenue minus additional cost, incremental cost minus depreciation will give you the EBIT. Once you get the EBIT multiplied by the tax rate will be the taxes. Tax rate will be what? You remember we have learnt about two types of tax, average tax and marginal tax, because it is about the incremental revenue. So incremental tax or the average, the marginal tax. Marginal tax is what? The additional tax on the additional revenue earned. Therefore, incremental revenue multiplied by marginal tax rate will be the taxes of the project. Then what will happen? Incremental earnings. Incremental earnings is equal to revenue minus cost. I'm not using the incremental, so it is in revenue means incremental revenue or additional revenue minus cost, additional cost minus depreciation of this project multiplied by 1 minus tax rate will be the incremental earnings. I hope it is clear. The same like we do an income statement, revenue minus cost minus depreciation multiplied by 1 minus tax rate. There normally we use the average tax rate. Here we use the marginal tax rate. Why? Because this is the incremental or additional earnings gained. So additional earning must be charged separately as per the marginal tax rate of the company. So incremental the tax will be equal to the EBIT multiplied by firm's marginal tax rate. Here is an example given. Cost of the machine is, for example, we for the new project, what happens? First of all, you have to buy the machine or install the machine. The cost of the machine here is 102 1 million 2000 to 20,000. 1,020,000 is the cost of machine. Life of the machine is equal to 5 years. Depreciation will be how much? Cost of machine divided by life. Cost of the machine is equal to 1,020,000. Life of the machine is equal to 5 years. Therefore, depreciation straight line method is 204,000 per year. Tax rate is, marginal tax rate is 40% for the company. Now it comes, now remember the flow chart we have seen in the very beginning. Initial investments or acquirement of the particular machine, that is equal to 1,020,000. 5 year is the life, so depreciation will be 204,000. If you install this machine, what will be the throughout the life, what you will get? You will generate, or the machine will generate, 500,000 per year incremental revenue. So the cash inflow year 1, year 2, year 3, 4 and 5 will be 500,000. For this incremental revenue, you have to spend incremental cost. From year 1 to year 5, you have the incremental cost of production will be 150,000. And to make this machine run, you have to spend 50,000 in the 0 year or installation expenses, 50,000. So it will be in the year 0, in the very beginning. We have seen in the beginning, during the life, end of the life. In the beginning, you have to buy the machine, that is 1,020,000. You have to spend 50,000 for installation of the machine. Once the machine is ready to work, from year 1 to year 5, the machine will generate 500,000 revenue. So this revenue will be additional for the company. So it is incremental revenue. For getting this 500,000, you have to introduce working capital. You have to, this project will need cost of production. The cost of production or incremental additional cost will be 150,000. Less depreciation. For EBIT, we have seen incremental revenue minus incremental cost minus depreciation. Depreciation of the project will be 204,000 per year. So 204,000 per year we have calculated here. So here it will be depreciation 204 from year 1 through year 5. Then you will get the EBIT. EBIT will be first year 0 year minus 50,000 because there is no revenue, only the additional cost minus 50,000. From year 1 to year 5, the EBIT will be 500,000 minus 150,000 minus 204,000 is equal to 146,000 from year 1 to year 5. Tax is how much? Given in the question, tax is equal to 40%. So 40% of 146,000 is equal to 58,400. Normally you pay the tax to the tax authority, so it will be minus. But in the very beginning, in year 0, it is plus. Why? Because the EBIT is negative. If you have profit, you will pay tax on that. So always remember, there is a principle we discussed in earlier chapters also, that if the EBIT is positive, tax is negative. EBIT and tax are opposite in nature. If EBIT is positive, tax is negative. If EBIT is negative, tax is positive. That means here minus 50,000 EBIT. So 40% of minus 50,000 is equal to 20,000 tax positive. They are opposite in nature. If you have profit, then you have to pay tax. If you have loss, you can claim credit in future tax payments. You have to adjust this in the future tax payments. So in the year 1, you need not pay 58,400, you need to pay 58,400 minus 20,000, because year 0 there is a tax credit you got 20,000. You need not pay tax. On the other hand, you will get a tax credit which will be adjusted against the future tax payment. So future tax payment first year is 58,400. You have to pay minus. Out of that 20,000 was the credit last year we have. So 58,400 minus 20 is equal to 38,400 you have to pay. This is the way tax is being calculated. So tax is 20,000, which is positive in the year 0, and remaining 1 year to 5th year you have a profit positive, EBIT positive, so tax will be negative. Then incremental earnings will be EBIT minus tax. I hope this is clear to all of you. And here is one more exercise given. Suppose that the managers of router division of Cisco Systems are considering development of a wireless home networking appliance called HomeNet that will provide both the hardware and the software necessary to run an entire home from any internet connection. In today's scenario, it is very appropriate example. So, a wireless router which can be used for operating your all home appliances from any remote places through this router. In addition to connecting computers and smartphones, HomeNet will control not only computers and smartphones, it will control internet capable televisions, streaming video services, heating and air conditioning units, major appliances, security system, office equipment, and so on. The major competitor for HomeNet is a product being developed by brand Kigley Corporation. So, the major competitor for this product will be brand Kigley Corporation. So, entirely it will operate all of the necessary equipment of your home, like the computers, smartphones, TVs, video streaming, heating, AC units, all the office equipments you can operate. And your competitor, major competitor, only one, brand Kigley Corporation. Based on the extensive marketing survey, before you do something, you have to do a extensive thorough research. So marketing research team has done that. HomeNet is forecasting 50,000 units. Sales is 50,000 units per year. This is a forecast. Given the pace of technological change, Cisco expects the product will have a 4-year life. So the life of this product will be 4 years. Expected wholesale price is $260. The price Cisco will receive from the stores. So the sales per unit will be $260. Actual production will be outsourced at a cost of 110 per unit. You need not manufacture this also. You will outsource this unit and you have to pay $110 per unit. To verify the compatibility of new customer internet ready appliances as they become available with the HomeNet system, Cisco must also establish a new lab for testing purpose. You will outsource this, but you have to test the quality. It should not happen that the vendor who will manufacture and provide, he has given a low quality product, then your brand will be in trouble. You will be bearing the problem because it is sold in your name. In Cisco's name, the product will be sold. If the third party who manufactures, if he makes some mistake and low quality product he provides, it is a problem. So you have to test the quality. Every time when you get a new lot, you have to randomly quality check. For that you need a new lab for testing the product supplied by your supplier or vendor or third party. It will rent the lab space for testing lab. You will rent out a lab space, but will need a purchase. You need to purchase a new testing equipment. The testing equipment will cost you 7.5 million. The equipment will be depreciated using the straight line method over a 5 year life. So 7.5 million will be the cost of the machine equipment, testing equipment. It will be depreciated over a 5 year straight line method. See, the product has a 4 year life, but the testing equipment which you are buying for testing the product, it has 5 years life. The lab will be operational at the end of 1 year. So after 1 year, you will start selling the product. At that time, HomeNet will be ready to ship. That means ready to sell. Cisco expects to spend 2.8 million per year on rental cost. So along with this testing equipment, the lab rent will be 2.8 million per year for the lab space, as well as marketing and support for this product. So all sell administrative, general, selling, all these expenses, SGA, selling, general and administrative expenses will be 2.8 million. Forecast the incremental earnings from the HomeNet project. All right. So very clear now. The question is, you are going to uh, sell a wireless equipment product, which will be very helpful in current scenario. It can remotely, it can control almost all the internet enabled equipments like your smartphone, your mobile, your AC unit, your heating unit, your video streaming, everything will be office equipments will be controlled through this router, and only one competitor is existing in the market. Now you made a market survey. 50,000 units can be sold in a year, and 4 years can be the life. Selling price will be 260. You will outsource this product. You will take from a third party vendor. 110 he will charge. You have to test the quality. You have to set up a lab for this. The lab equipment will cost 7.5 million. The selling general administrative expenses will be 2.8 million a year. So before starting the question, let us do the workings like the revenue per year, incremental revenue, because we have seen how to make the kind of incremental cost benefit analysis. First one, incremental revenue from this particular product. Cisco will get 50,000 multiplied by 260 is equal to 13 million. Incremental cost, that is the per unit cost multiplied by number of unit. 50,000 multiplied by 110, 5.5 million. Next is SGA. SGA given in the question for the testing lab, 2.8 million. So these are the cost. 5.5 million is the direct cost for buying the item. 2.8 million is the SGA, selling general administrative expenses. Depreciation, 7.5 million you will spend for the testing equipment. It will have a 5 year life, so the depreciation will be 1.5 million. So the total cost will equal to 5.5 million for the production cost or the cost of acquiring cost. 2.8 million will be the SGA. 1.5 million is the depreciation, and the incremental revenue is 13 million. Marginal tax rate for this product is 40%. So we can develop a spreadsheet here, which the copy of from the spreadsheet is brought here. Revenue is 13 million being calculated here. So 13 million is the revenue. Cost of the goods sold is 5.5 million. That is 50,000 multiplied by 110 is equal to 5.5 million. Revenue minus cost of goods sold is equal to gross profit, 7.5 million, minus SGA 2.8 million. Depreciation minus depreciation is 1.5 million. EBIT will be 7.5 million minus 2.8 million minus 1.5 million is equal to 3.2 million is the EBIT. Income tax, that is the marginal tax rate, is 40% for this incremental EBIT. So 40% of 3.2 million is equal to 1280 million, 1.28 million. So incremental earnings will be 1.92 million. I hope it is clear to all of you. So this is the way when we do and this 1.92 million will be year 1 to year 4. In year 5, you see, year 5 is a very typical year for this project now. Why typical year for this project? The product has a 4-year life, but the testing equipment have 5-year life. So the product will stop giving revenue in the 5th year because you don't have any 5th year for this product. The product will generate 50,000 units per year sales from year 1 to year 4. Year 4, the product, new competitors will come and this product will start not existing in the market. So no more sales in the 5th year. If there is no more sales, no more direct cost, no more gross profit, no more SGA, but depreciation will be 1.5 million. Why? The testing equipment which you purchased, it is having 5 years life. It's 7.5 million is the cost, 5 year is the life. So it will start from year 1 to year 5. That means EBIT will be minus 1.5 million in the 5th year. If EBIT is minus, tax will be plus. Remember the relationship of EBIT and tax. If EBIT plus, tax minus. If EBIT is minus, tax is plus. Means you get a tax credit. So 600 million you get 600,000 you get a tax credit. Therefore, the incremental earnings in the year 5 will be 900,000. Whereas from year 1 to year 4, 1.92 million. But in the 5th year, the depreciation cost will make the EBIT negative 1.5 million. Tax will be 40% of that. Opposite of that is 600,000. 1.5 million minus plus 600,000 is equal to minus 900,000. That will be the tax credit you get in the year 5. Evaluation. These incremental earnings are intermediate step on the way of calculating incremental cash flows that would form the basis for any analysis for home net project, whether to invest or not. This calculation, before you go to your top management, you need to make this kind of analysis, and with this kind of calculations you can go to the top management for the discussion. Cost of the equipment does not affect earnings in the year it is purchased, but does so through depreciation expenses in the following 5th year. I just explained you. In the 5th year, there is no revenue, there is no cost, there is no SGA, but there is depreciation because the testing equipment has 5-year life. So, incremental earning forecast. For doing this, what we have done, we made a pro forma statement. What pro forma statement? The pro forma statement from year 1 to year 5. That is the projected statement. So for incremental earnings for a new capital expenditure decision, you need to do the pro forma statement. You need to predict the tax and negative EBIT. When there is a negative EBIT, tax will be plus. When there is a plus EBIT, positive EBIT, tax will be minus. Interest expenses will not be considered here. We will consider it as an unlevered net income for the capital budgeting decision. We will stop the recording here. Just give me a minute.